This is Brian Stutland of Equity Armor Investments here with my colleague Joe Teague, as always. Our show Market Matters, sponsored by the Miax. We have a great show on tap. And really, Joe, what's been going on with, let's just get into it. What's been going on with GameStop? Is meme and inflation back on the table?
Yeah, hi, how's it going? I just got booted, but we're back. No worries here. Yeah, it's fascinating to see. It's fun to watch. I guess Roaring Kitty is back on Twitter, and that makes GameStop rally 40%. Really is something crazy to see. I'm not so sure this really means the meme stocks are back, but there are some high flyers flying around out there. You got a lot of crazy valuations. Maybe the Trump digital media company is another meme stock that's flying around like crazy. But we're up to 20 now in GameStop. Nowhere near where we were in 2020, Brian, when the GameStop traded 350, 400. I don't remember, but it was ridiculous back then. Are we back there? Are we on the way towards there? We'll see. It should be fun to watch.
Yeah, well, I mean, I would just say this is our big story of the week because we really want to break down what GameStop really means for inflation, because there's actually a pretty high correlation of all this irrational exuberance, so to speak, that takes place. And is that just excess capital that's lying around looking for somewhere to go and taking out those who are actually short that excess capital and taking those people out? So we really want to get into it. It's going to be a great show, just a little discussion around that, what that means for the market, inflation, where the Fed is going to be taking things. And, you know, as this little meme and characteristic shows, like pressing forward, maybe that means inflation's pressing forward and moving higher.
When's the last time you went into a GameStop?
Never.
I think it's been about 20 years for me, maybe. So you got kids high school age. Do they ever go there?
No, I mean, I do have kids that are, you know, avid PlayStation gamers or whatever. It's all digital, right? I mean, just download whatever you need and go from there. And I don't know what you really find in GameStop that's not found elsewhere in the world, but they do have sales. You know, they do generate sales. So, you know,
they restructured their debt. They're debt free. That's great. But where's the growth going to come from? I don't see it with their current business model. They got to pivot somehow. I think the online sales for video games is free, but that's just another story. Speaking of stories of the week, it's going to be inflation, Brian. We're talking about that right now. CPI week. That's going to move the market. The last, dozen inflation numbers every month. We're getting like a huge market moving event for the economy, and the market moves big off of it. So we'll be watching that. We also have big earnings coming out of China this week. JD.com, Alibaba, to name a few. A Big Short fame. Matthew Berry is really big into these Chinese companies right now. So we'll see if he's got another one right here. But we're going to look at Cisco. We're going to trade Cisco on earnings because they have an earnings coming up on Wednesday.
Yeah, it should be an interesting week for Cisco. They're kind of an interesting stock, and we'll get more into it. But I think I have a good way to play it actually, with the earnings coming up on Wednesday for Cisco and options expiration Friday.
So we are coming into the inflation week, looking at volatility, Brian, and it's low. We are the lowest line here on this chart, and just a month ago, look at that. Like, it was off the charts a month ago at the start of April, second week of April. We had super high volatility, really flat volatility curve, volatility skew at the start of April. But now come all the way back down, a little bit steeper in that curve. But really, people are not expecting volatility for the summer months here.
Yeah, I mean, it is normal to see volatility trade lower over the summer months than normal, meaning option prices are typically relatively cheaper because the market doesn't move as much historically, whether it's people going on vacation, Europe taking vacation on the back half of the summer, whatever the dynamic is, we do see less realized volatility. And so now the VIX futures curve is sort of trading down lower. To me, though, it seems like it's gotten a little stretched, Joe. I mean, look how far it's fallen versus just a month ago when we did have all this volatility in April. We saw how quickly it can move up to there. And now, this is a mean reverting product. Now we're actually below where it was even a month ago or a week ago. So maybe it's a little bit oversold here.
Well, let's take a look at what the skew has to say about that. We've talked before, if you like this volatility content, this is something we're looking at every week. So make sure to tune in for this. But we looked at the skew and it was coming in last week. It seemed like it was in a good spot, but it may be starting a tick higher. I want to see what happens. Are we going to get a relative high here above this level this week? But it could be at a spot where it hit a relative low and volatility wants to go higher.
Yeah, and for people who are just tuning in for the first time, and as we go over some of these volatility structures, we found that this is a pretty good bear bull indicator, which what it does basically is it's measuring out of the money put versus an out of the money call. The call being a play to the upside, the put being a protection on the downside or a way to play a short to the downside. And when one typically in the S&P 500, puts are priced at a higher premium than calls. But when we want to see how that balance is reacting with each other, and we saw this absolute shift into call buyers, people selling puts, buying calls, trying to play to the upside as we sort of got this volatility spike. And then all of a sudden that simmered out and the market rallied. Now we're actually seeing puts get bid up a little bit relative to calls. And so to me, that I'm watching this because if this thing ticks up above, let's say, 3.0 on the relative to each other, to me, that's an indicator. Institutional buyers are looking for a put. They're looking for some sort of, 5 or 10% pullback correction coming up. So I'm really watching that because, this was finally the first real uptick in this skew and where we really saw put buyers come into the market.
Yeah. And this is the ultimate risk off, risk on. You want to take risk off, you're buying puts, put risk on, you're buying calls. So what's the sentiment? Right now it's shifting back towards risk off. Are we in the early stages of that? Or are we going to go back to risk on? We'll see more after the CPI number, which is going to be all about, exactly how many cuts the Fed is going to do. Is it going to be 0? Is it going to be, I guess there's a 3.5% chance of 4, but likely it'll be 0 to 3 cuts by the end of this year. The base case right now, Brian, is 2, or at least the most likely at 36% as 2 cuts of what we're expecting by the end of the year.
Yeah, and this is really our big story of the week here. I mean, we talked about the meme stock and GameStop and the relation of that to really when that started exploding, we did see a big uptick in inflation. Was that coincidental? To me, no. I think that was a label of excess liquidity that was out there in the marketplace looking for a place to go as an early indicator of inflation coming down the pipeline. And when you look at this Fed stance on where we're going to be, it's now becoming less and less likely that we get, let's call it 2 rate cuts that people thought maybe 1 is coming. But to me, that's probably about it because I think people are getting this angst about some of these CPI numbers that have ticked up. And this certainly will be a big week when we get that number.
Yeah, well, for me, if we're going to get 3 or 4 cuts, it's going to be more about a softening economy, which will come with the deflation. Maybe the sweet spot for the soft landing is going to be 1 or 2 cuts, Brian, where the economy doesn't get too soft. The Fed cuts a couple times and pauses. Typically, though, I'm worried whenever the Fed does cut because that usually means a softening economy.
Yeah, and we've had such a dovish Fed over the last decade, call it. And it's really fueled a lot of inflation in areas that people didn't expect. But yeah, I mean, look at the chart there on the CPI. Right. We're back kind of in that normalized territory, right, Joe? I mean, the 4% inflation, they say they want 2% target, but 4 to 2 has usually been
it
good.
Looks like it really is 2 to 4. That's their real target. They say 2% is their target, but based on the past 25 years, is that realistically what they're shooting for?
No, I mean, yeah, right. I mean, we're probably in a normalized territory. Maybe that's why people feel like we can afford to cut rates because we're back in the normal historical range of inflation. We just don't want that to tick out of that trend that you typically, that channel that we show here in red. I would want to see to make sure it's near the lower end of that channel so that I know and I feel comfortable that we're going to stay in that channel.
Yeah, maybe that's like one of the secrets that they say 4, but they mean 3.5, or what the real target is. But it is amazing because, and even in the past, since the 2000s, we were told, China's exporting all this stuff to us, or keeping all these prices low. Inflation has been historically super low. It still has been a little bit elevated over that period, over the Fed target still.
Yeah, it has. And, look, I mean, if they can kind of maintain it in this range, then the market can probably kind of normalize. The 10-year probably should sit closer to 5% as we get like a an inversion back in the Treasury yield curve to get things back to normal conditions. I mean, if we are in this normal range, I would like to see the yield curve be in a normal range, because to me, things are still out of whack.
And here's the other thing with the CPI, Brian, is it's already X food and energy, and they're adjusting it every 2 years, maybe massaging it, different things are, part of the basket than they used to be. Maybe people's habits change over time, but really that's a lot of hands-on manipulation, not manipulation. Maybe I'm putting words that I don't need to, but could be considered that. A lot of hands-on, massaging of the data. And I went and looked, and what's some main things that people need, that people necessities that they have to pay for. Just in the past 25 years, we know the Fed saying, hey, our goal is inflation is going to be 2% a year. Well, hospital costs are 11% annualized increase over the past 25 years. Home prices, 9.7% annualized increase. College costs, almost 8%. Food, almost 6% increase year over year. In cars, the best one of the bunch, but still 3.5%. So these are just things that people need to survive on a day-to-day basis. And the inflation seems like it's a lot bigger than advertised.
Yeah, we need a survival inflation index, I think, Joe, to create, because that thing is off the charts. If I'm someone in the middle class and I'm trying to move up in the world, what do I want to do? I want to buy a home. I want to get well educated so I can get myself a good job after college. And eventually, when I get older, I'm going to have some medical costs. And if you look at those top three things that have just been off the chart for the 25 years now at annualized rates, that I'm not sure the rest of America can keep pace with that. And so to me, that's the most concerning in the whole inflationary picture, is that those areas are not being addressed like they should be. Now, maybe the Fed can't control those things. Maybe that's something that's, circumstances that are just, out of this realm. But when I look back at how dovish the Fed got after 2008 and the Great Recession and the financial crisis that occurred during that period, to me, they got overly dovish there, allowed the fuel in the fire to sort of sit here in home prices and college education and healthcare costs to just stew and continue to boil up over time. And to me, that seems like a bubble that is going to hurt and create some pain at some point.
Well, something's got to give when you look at these college prices and the home prices. If you're graduating from college now, how can you afford, given the debt that you've taken on already to get out of college, how can you afford to buy a new home? Will there be some sort of bubble when the baby boomers pass on and a lot of houses come on the market? Maybe that's one catalyst, but at some point, the home buyers are just struggling to come up with the money to buy a new house. It just is hard to fathom this can go on in this fashion.
Yeah, I mean, just the trend is just so much higher, and that maybe this is beyond the scope of what you and I can control, Joe. But this is a policy thing that I think needs to be discussed. It's something that the Fed needs to address beyond just the CPI number. Great, okay, my Apple iPhone is staying at the same price, or my TV has gotten cheaper, so now I can have a 60-inch screen TV versus a 40-inch at the same price. But in terms of quality of life, those top three things are very concerning, and it's something that I think will cause some sort of market disruption for the rest of the marketplace at some point. That'll come to roost.
Yeah, I mean, that doesn't even get into telephone costs. Actually, you talk about cellular costs, like just those are a necessity now. Yeah, that is just our 2 cents. The Fed has said, the Congress should step in. They should, cut the budget. Congress is saying, Fed, you need to lower interest rates to make business conditions better. So, yeah, it just seems like nobody has any interest in actually solving the problem, which I think is a problem. Maybe not right now. Maybe it'll be good for the stocks for the short term, but in the long term, something's got to give.
Yeah, and just to button this up is like, what kind of trade is comes out of this whole situation is, I think consumer discretionary stocks that aren't very innovative will struggle, because so much of everybody's regular costs of the U.S. consumer is going to some of these other things. And so I think, Joe, we've kind of stayed away from, let's say, a Nike, so to speak, as being any sort of major holding in a portfolio, something like that, because that's just something, okay, shoes, that's cool, we'll wear it. I have my own Air Jordans or whatever that I love, but I think it's got to be an up and coming consumer discretionary, something like a Shake Shack that's, all of a sudden expanding everywhere that wasn't before. Other than that, I think a lot of these other consumer discretionary stocks are really in trouble because of what's taken up on other people's budget and have to go towards that now. And so it's really for me, it's technology, it's consumer staples. That's really where I want to be.
Yeah. Well, let's move on to the stocks of the week. Last week, we were talking about an earnings play coming up later in the month. That'll be NVIDIA. We'll be watching that closely. Last week, the trade we were looking at was this call spread, finance it by selling a put spread. Very little movement in the stock. The trade is actually very close to where we put it on. I think it'll move. This is going to move after the CPI, Brian. I think a good number. NVIDIA is almost certainly going to be higher. A weak number could be challenging for NVIDIA if the interest rates are going to be going higher. That could stifle some growth names. So we'll see how this looks later in the week. But the plan was to look at this up into earnings, maybe trade it ahead of the earnings or keep it on through the earnings. But I got another chart for you. I went and looked at this stock, which we're going to trade back from 1996 to 2000, and it looks a lot like NVIDIA. If you remember, Cisco was the NVIDIA of the dot-com era, and maybe that's a word of caution for NVIDIA because we know what happened. Their valuations got super stretched and boom, fell off a cliff after the dot-com bubble burst. However, it's had a fantastic recent run. We're back up to the all-time highs, but we're doing it in a different way, Brian. We're doing it on actual sales, and we're doing it on actual revenue. We got a PE down at 14 for NVIDIA. Here's just a one-year chart. It looks like a little bit of a wedge, but you look at it over this 5-year pattern, looks like it's trending higher, and we're kind of in the middle of this range.
Yeah, I mean, Cisco was the new tech. It was the NVIDIA of the 2000 dot-com. I still feel like we're kind of still in the 96, 97 area of things in technology. So to me, that would mean NVIDIA still has some upward movement to go, although those overlays of charts are a little bit scary on where NVIDIA would be. And that's why we use options a lot of times to put NVIDIA positions on. If I'm an individual investor, I want to sort of, de-risk myself to some degree. But yeah, Cisco's now become the old tech, really. But if you look at this, I mean, it seems like it hasn't gone anywhere to Cisco over the last 5 or 10 years, but really it's had a nice just trend upward. And then you couple that with a little over a 3% dividend yield on the stock. It hasn't been a bad investment. It's been more of that safe technology investment. But the reason why we want to trade it, not only earnings, but obviously they had a big deal, right, Joe? They're really expanding more out of their hard networking area.
Yeah, they've been doing a lot of M&A activity, and I love the most recent one. It was their largest one they've ever done. They spent $28 billion to buy a company called Splunk. So we know NVIDIA is really big in their networking, their routers, their connectivity, their security play. Splunk is going to be another add-on for them. It really helps the IT portion of them. Big companies with lots of connections into their networks is really critical for them to have a better security play. Splunk has all that, and they have kind of like the big data AI, this the Excel AI, which can take a lot of data and make some decisions based off of the data, which is different than like a language model. AI, but it's more like just looking at data in real time, millions of inputs, very quickly making decisions off of that. And I think this is going to be a security solution. Any company, any S&P 500 company with thousands of connections into their network, think of healthcare systems, think of governments with thousands of connections, within governments, different different branches of government that have thousands of connections into their network. I think this is a critical piece of security that is going to be more and more desired as we get further on into this world of ransomware and malware, and the hacking continues. So I think this is critical. I think it's a huge play for them, and I think this is going to really build into their services sales, which is now their largest revenue creator.
Yeah, it is. And so look, we have a trade on it. I think I want to use, you look at that trend channel and it is kind of wedging. So there's some risk that earnings kind of disappoint and people don't really know how this whole Splunk deal is going to play out. And they take the stock lower down into the low 40s. Stock, just trading above $48 a share right now. I'd rather use options to sort of play this one-time earnings event. And I'm looking at the May, this is expiring this Friday, 50-52 call spread. Now, historically, the stock has moved a little over 5% after earnings. That's what the options market is implying. So I'm going to try to offset some of the call buy that I make of the 50 call by selling that 52 call and turn it into a call spread that just costs 50 cents. So think about this. I'm risking 1% here on a stock that is likely, at least historically, to move 5% after earnings, right? And so now I'm risking 50 cents to make $1.50 if the stock trades above $52, which would really put it on a pretty large, sizable move relative to what it's done in previous earnings. But this would be a way for me to sort of initiate and get into the stock if earnings are good, because I can use the call spread to do that. And if things go bad and the stock falls, what I might be looking to do is really sell a put, let's say below the 45 strike. I don't want to sell it now. I don't want to sell a put when the stock is trading in the middle of this sort of trend channel. I want to wait for it to pull back. And at that point, I could sell a put to sort of offset the cost of this call spread I'm buying. So I can do a wait and see after earnings on how I want to get into the stock, because I certainly would be okay owning Cisco. I think we would probably be buyers of it even for clients if Cisco stock were to go down to $45 or drop around that area. And so this is a good, to me, seems like almost a free call spread. There's a cost to it, obviously. Nothing's free. But I can make up some of that cost if the stock drops. I'll sell a put and be willing to be put to the stock at a lot lower value. But in the meantime, I can play to the upside here on the earnings event. Hopefully we get through spot 50 as the break-even point and can make some money on this.
Yeah, no, I love that. We could be looking at a spot where we're like at this point of the trend channel, or it could be at this point. So yeah, makes a lot of sense to play this with options. For me, I love the risk reward on this trade. Actually, risking 50 cents above 52, you make the trade is $2, so it's $1.50 profits. You got 3-to-1 risk reward on that. I think that's pretty attractive.
Yeah. Well, Joe, this has been a great show. We talked inflation. We talked
another
Cisco.
Great show.
Yes, yet again. Yes, make sure you tune in every week. Subscribe to our channel, Equity Armor. We'd love having you. Feel free to write comments. Again, Joe brought up the trade on NVIDIA. We'll continue to update that as earnings get closer by. But tune in every Monday, 1 p.m. Eastern, on the Trader Hub channel. This is Market Matters, sponsored by the Miax. I'm Brian Stutland of Equity Armor Investments, and
I'm Joe Tige, also of Equity Armor Investments.
All right, catch you next week, folks.
Have a good one.
All opinions expressed by Trader Hub contributors are solely the contributors' opinions and do not reflect the opinions of Trader nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Trader nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Trader Inc. is the parent company of Trader Brokerage Inc. Trader Brokerage Inc. and Trader Inc. are separate entities with their own products and services. Securities products and services are offered through Trader Brokerage Inc. Trader Brokerage Inc. is an independent subsidiary of Trader Inc. All rights reserved. Member FINRA SIPC.